Home sales just hit their lowest level since 1995. And I mean, not 2008, 1995. Welcome to the deep dive.
Yeah, it's honestly wild to actually hear that out loud.
Right. I want you to really let that year sink in for a second. We are talking about a time before most people even had an email
Oh
address.
yeah, dial-up internet, blockbusters on every corner.
Exactly. A time when the U.S. population was, roughly 70 million people smaller than it is today. Yet somehow more homes were changing hands back then than they are right now.
Which is just staggering.
It is. And with mortgage rates sitting stubbornly above 7%, something in this massive, complex system is, well, it's about to break. Yet, if you ask the average person on the street, they probably have absolutely no idea what this silent freeze means for their own net worth.
It really is a staggering reality check, isn't it? Because when we look at the data surrounding the 2025 U.S. housing market, and specifically, the mechanics of this looming correction, it becomes super clear that panic is really just the absence of a plan.
Oh, I like that. Panic is the absence of a plan.
Exactly. And to build a plan to protect your money over the next 12 to 24 months, you really need to understand the underlying math. It doesn't matter if you own a home right now, or if you are renting an apartment and trying to save up, or if you are desperately trying to buy your first place.
Because it affects everyone.
Right. The mechanics of this shift are going to ripple through your monthly payments, your financial options, and really your overall security.
Which is exactly our mission today. We are going to cut straight through all those sensational headlines, break down the cold, hard numbers of what is actually happening out there, and lay out the exact steps you can take to shield your wallet.
That's the goal.
But before we can talk about how to protect our money, we have to understand exactly what we're protecting it from. Because I know for a fact, the moment people hear the phrase housing crash, everyone's brain immediately jumps to one specific year.
2008.
Exactly, 2008. We picture like foreclosures on every street corner, empty subdivisions, total financial chaos.
And that 2008 hangover is exactly what is blinding people to the reality of 2025. Because structurally, we are looking at two completely different animals here.
How so?
Well, in 2008, the crash was fundamentally a credit crisis. It was driven by bad subprime loans, banks handing out mortgages to people with no income, no jobs, no assets.
Right, the classic NINJ loans.
Exactly. And when those adjustable rates reset, millions of people defaulted simultaneously, which of course led to over-leveraged banks and massive forced selling. Millions of properties just flooded the market all at once, creating this massive oversupply, and prices collapsed.
Just totally tanked.
Yeah. But today, we aren't looking at a bad loan crisis at all. We are looking at a pure mathematical affordability collapse.
Okay, let's unpack this math of the affordability collapse, because breaking down the actual numbers from the data completely shifted my perspective on this. Let's look at a totally average scenario today. So the median U.S. home price right now is roughly $420,000. If you take that median price and apply a 7.1% mortgage rate, which is where we've been hovering, you are looking at a monthly payment of about $2,800.
Right.
And keep in mind, that is just principal and interest. That doesn't even factor in property taxes or home insurance.
Which is a huge point. And that $2,800 figure, that's the linchpin of this entire crisis. Because you have to compare that monthly cost to what Americans actually earn.
Okay, so let's run those numbers.
So the median American household income is roughly $78,000 a year. If you break that down, it comes out to exactly $6,500 a month in gross pre-tax income.
Okay.
If you take that $2,800 mortgage payment, it takes up exactly 43% of that $6,500 gross monthly income.
Okay, wait, let's pause and unpack this, because 43% isn't just some random statistical observation, right?
Yeah.
That specific percentage is a massive brick wall.
It is the absolute ceiling. 43% happens to be the exact maximum debt-to-income ratio, or DTI, that most conventional mortgage lenders will ever approve. So this current freeze isn't about buyers just being nervous about the economy or patiently trying to wait for a better deal. The math is literally physically capping buyers out of the market.
It's essentially illegal for the bank to give them the loan.
Exactly. A perfectly average American family making an average income, trying to buy an average home, is mathematically disqualified from getting the loan. They cannot get the money, even if they are begging for it. Demand hasn't just softened, it has been mathematically broken by that 43% limit.
That is wild. So demand is absolutely shattered, but the other side of the equation is supply. And this is where we see this massive lock-in freeze. We're looking at a scenario where roughly 85% of current homeowners have mortgages with interest rates locked in below 5%.
Yeah, and most of them are in the 3% or 4% range from the pandemic era.
Which is crazy to think about now.
It is. Think about the behavioral economics of that for a second. If you own a home with a 3% mortgage and you decide you want to move, maybe, you had another kid or you want a different neighborhood.
Sure, just normal life stuff.
Right. And you go to buy a new home that costs the exact same amount as your current one. Your monthly payment is going to jump by hundreds, maybe even thousands of dollars, purely because of the jump from a 3% rate to a 7% rate.
You'd essentially be paying double the interest for the exact same house. So, you just don't sell, you stay put. It sounds like a game of musical chairs where 85% of the people are super glued to their seats.
That's a perfect way to put it.
But wait, this is where I get tripped up.
Yeah.
If nobody is selling and the supply of houses on the market is frozen artificially low because everyone is hugging their 3% mortgages, shouldn't that extreme scarcity keep home prices high? How does a major price correction actually happen from a freeze?
Well, if we connect this to the bigger picture, it all comes down to the tension building in the system. You have this massive gap between frozen supply where nobody wants to sell and broken demand where nobody can afford to buy.
Right.
So the market enters this pressure cooker state. Transactions essentially drop to zero because the price sellers want and the price buyers can actually get approved for are miles apart. But historically, a market can't stay frozen forever. Life happens.
What do you mean, like emergencies?
Yeah, people get divorced, someone passes away, maybe a family has to relocate across the country for a new job. These are the forced sellers. And when those forced sellers put their house on the market, they suddenly realize the pool of eligible buyers is practically zero.
Because everyone else is capped out by that 43% debt-to-income ratio.
Precisely. So to find that rare buyer who can actually afford the monthly payment at 7%, the seller has to slash their asking price dramatically just to bring the monthly math back down to reality for the buyer.
Wow.
And when those slash sales start hitting the public record, they become the new comps.
The comparable sales.
Exactly. The comparable sales that appraisers use to value every other home in the neighborhood. That single mechanism is exactly what precedes a broader price correction.
Oh man, that makes the mechanics so much clearer. It's not a flood of inventory crashing the market like in '08. It's a drought of qualified buyers, forcing the few desperate sellers to drop their prices.
You nailed it.
So the pressure is building because sellers are stuck and buyers are capped out. When that pressure cooker inevitably vents, it doesn't spray everyone equally, right? A 20% price correction hits different people wildly differently.
Oh, absolutely.
It depends entirely on whether you are an owner, a buyer, or a renter.
Yeah.
So let's walk through these three profiles because the financial exposure here is incredibly specific. Let's start with the current homeowners.
Okay, so for the vast majority of homeowners, the initial message from the data is actually quite reassuring. If you are happily living in your home and you have no plans to sell in the next 3 years, you're largely insulated.
Okay, that's good news.
Yeah, your fixed monthly payment doesn't change, the roof over your head stays the same, and your daily life just goes on. Unless, and this is a big, unless you fall into a very specific vulnerable subgroup.
Which is who?
Those who bought recently at peak market prices with a very low down payment.
Yeah, and working through the math on this scenario is pretty brutal. Imagine you finally scrape together enough cash to buy a home in 2021 for $450,000, and you put 5% down.
Right.
That's a $22,500 down payment. That means your total loan from the bank is $427,500. Now, if we see a 20% drop in home values across the board, that $450,000 home is suddenly only worth $360,000.
But you still owe the bank that original $427,500.
Exactly. You owe almost $428,000 on a piece of property that the market says is only worth $360,000. You are underwater by $67,500.
It's terrifying math.
It really is. If you suddenly needed to move for a job, you literally could not sell that house unless you brought a physical check for almost $68,000 to the closing table just to pay off the remainder of your mortgage. You are entirely physically trapped in that property.
It is a complete evaporation of your financial flexibility. But, to understand how localized that pain is, contrast that with someone who bought just a couple years earlier, say in 2019.
Okay, so before the crazy peak.
Right. If they bought a home for $320,000 and put a traditional 20% down, they entered this volatile period with a solid cushion. Even with a 20% drop from the recent absolute peak, they still have roughly $144,000 in equity today. They still have options.
So timing really is everything.
Absolutely. The timing of your purchase and the amount of leverage you used completely dictate your reality during a correction.
Okay, so owners are either totally fine or they're just trapped by their own debt. But ironically, the people trying to buy their way into this market are facing the exact same mathematical wall, just from the outside.
Yes, they are.
Let's talk about the buyers. Because looking at the data, there is a massive counterintuitive reality check here. You would think a 20% price drop is an absolute dream scenario if you've been waiting on the sidelines to buy.
It sounds great on paper.
Right. But the math tells a completely different story.
It really is a devastating realization for many prospective buyers, because a drop in the sticker price of a home only helps your monthly budget if interest rates drop significantly alongside it.
Show me how that works.
Let's run the comparison. If you buy a $400,000 home today at a 7% interest rate, your monthly payment for principal and interest is roughly $2,661.
Okay, got it.
Now, imagine the market crashes. The price of that exact home drops all the way down to $340,000. You're thrilled, right?
Yeah, I'm thinking I just saved 60 grand.
Exactly. But if rates stay relatively high, say they only dip down to 5.5%, your monthly payment on that cheaper home is still roughly $1,931.
Okay, so seeing a 20% price drop as a buyer feels exactly like walking into a massive Black Friday sale. You see that big red 20% off sticker on the TV, and you get incredibly excited.
Right, you think you scored a deal.
But then you drag it to the checkout counter, and the cashier tax on a mandatory shipping and handling fee, which is that 7% interest rate. And that fee completely wipes out the entire 20% discount you thought you were getting. The sticker price went down, but the amount of cash leaving your bank account every month barely budged.
That analogy hits the nail on the head. The monthly cost of holding the debt matters significantly more than the sticker price of the asset itself. Honestly, the only people who truly emerge as winners in this buyer scenario are the ones who have been religiously hoarding cash.
The cash savers get to completely bypass the shipping and handling fee.
Pretty much.
If you were priced out over the last few years, but you kept renting and diligently saving your money, you were stepping into a massive power position. Think about it. If you managed to save $90,000, which would have been a 20% down payment on a $450,000 home at the peak, and that same home drops to $360,000, your $90,000 cash pile is now a massive 25% down payment.
The math completely flips in your favor.
You qualify for the loan much easier, your monthly payment plummets because you're borrowing so much less, and you are entering the market with massive leverage.
Which brings us to the third profile, and honestly the one that's often the most overlooked in these conversations.
For renters.
Yes, the renters. When housing prices swing wildly like this, what does it actually mean for them?
Well, the data notes that in the short term, rents might actually drop a little bit, as some of those highly pressured landlords are forced to sell, or, as new apartment buildings finally finish construction, it might increase rental inventory mildly and give renters a break.
Right.
But, and here's where I really want to push back on the conventional wisdom, if rents are ultimately tied to the local job market and what people in a specific city can actually afford to pay, why should a renter even care about this macro housing market data? I mean, if they aren't buying, isn't this all just background noise?
See, this raises an important question, and it highlights a dangerous blind spot for a lot of people. A housing downturn never exists in a vacuum. Historically, major real estate corrections bleed deeply into the broader economy.
How so? Like job-wise?
Exactly. Think about the ecosystem. When housing freezes, construction slows down, lumberyards lay off workers, mortgage brokers and loan officers lose their jobs, title companies shrink.
Oh, wow. It's a huge chain reaction.
It is. And perhaps most importantly, the psychological wealth effect disappears. When homeowners feel their equity shrinking, they stop spending money at local restaurants, they delay buying a new car, and retail spending drops.
Because they don't feel rich anymore.
Exactly. So for a renter, the real existential threat isn't a spike in their monthly rent, it's the fact that their own job security might be directly downstream of this housing freeze.
That makes total sense. So the common denominator for all three groups, the vulnerable owner, the frustrated buyer, and the renter, is broader economic uncertainty. Which brings us to the most practical part of this deep dive, defense and offense.
My favorite part.
Since job insecurity and economic ripples threaten everyone, we need a universal playbook to weather this. The data provides three very concrete, non-speculative money moves you can make right now to protect yourself. So let's start with move number one, which is pure defense, locking your liquidity.
And we need to be incredibly precise about what liquidity actually means here.
Let's define it.
The baseline recommendation is securing 4 to 6 months of vital living expenses in cash that you can access within 24 hours. And to be crystal clear, This does not mean money sitting in a 401k. This does not mean money tied up in index funds or the stock market.
It has to be literal cash in a break account.
Yeah.
Because I think people forget what happens when the economy actually tightens. Banks get spooked. They literally start slashing the credit limits on your credit cards without warning.
They absolutely do.
You cannot rely on borrowing money or selling off stocks, which, by the way, might also be down 20% to bridge the gap if you or your partner suddenly lose a job. Cash in hand is the only unshakable defense when the system seizes up.
Exactly. It buys you time, which is the absolute most valuable asset during a correction. And once your defense is set, move number 2 is where we start playing offense.
Putting your cash to work.
Yes, putting your cash to work while interest rates are still historically high, specifically by utilizing high-yield savings accounts, or HYSAs.
This is the bizarre silver lining of the exact same interest rates that are crushing the housing market, isn't it? Those high rates mean your standard savings can actually generate real, risk-free returns for the first time in over a decade.
It's an opportunity you can't ignore.
The math here is almost too simple to ignore. A high-yield savings account right now pays anywhere from 4.5% to 5% interest. So if you have an emergency fund of $10,000 sitting there, the bank is paying you roughly $450 to $500 a year.
Right.
But if you have that exact same $10,000 sitting in a regular legacy bank account, the big brick-and-mortar ones paying like 0.1%, you are earning a pathetic $10 a year. That is a 45 times return for doing absolutely nothing differently other than choosing a better place to park your money.
It is essentially free yield. And if you are that prospective buyer we talked about earlier, the one aggressively hoarding cash and waiting for the market to drop, parking your growing down payment in a high-yield savings account means your money is constantly compounding.
And fighting off inflation.
Exactly. Fighting off inflation while you patiently wait for the right moment to strike.
Which leads us perfectly to move number 3. The ultimate signal. And here's where it gets really interesting, because it challenges our entire cultural addiction to real estate. Everyone I know who wants to buy a house is essentially doing the same thing.
Let me guess. Looking at their phones.
Scrolling Zillow every single night in bed, desperately looking for little red arrows indicating a price drop. But the data says we all need to stop watching Zillow. It says the true signal to watch is the 10-year Treasury yield.
Which sounds way less exciting, I know.
Wait, run that by me. Checking Zillow is basically looking in the rearview mirror. Why is this boring government bond, the 10-year Treasury, the magical green light for the housing market?
So what's fascinating here is the actual mechanism of how mortgages are priced by the banks. When you look at Zillow, you are looking at the prices of homes that went under contract 30 to 60 days ago. It is purely backward-looking.
Right, it's history.
But to understand where rates are going, you have to understand bank behavior. Even though a standard mortgage is a 30-year loan, banks know that the average American homeowner either moves or refinances their house every 7 to 10 years.
Okay, so the lifespan of the loan is usually only a decade?
Precisely. Because the loan typically only lasts about a decade, banks use the U.S. government's 10-year Treasury bond as their baseline benchmark.
Oh, that connects the dots.
Yeah. They look at what it costs the government to borrow money for 10 years. They add a little bit of a premium on top for the risk of lending to a regular person instead of the government, and that becomes your 30-year mortgage rate.
So they are intrinsically linked. Currently, the 10-year Treasury yield is sitting around 4.4%.
And that is the number to watch. When the 10-year Treasury yield consistently drops below 4%, that is your leading indicator. Because when that government bond yield drops, the bank's borrowing costs drop, and mortgage rates will immediately follow.
And when mortgage rates fall, what happens?
That brutal 43% debt-to-income wall we talked about earlier finally comes down. Suddenly, the average family's monthly payment drops from 43% of their income down to, say, 35%.
They qualify for the loan again.
Exactly. Affordability returns to the market. So if you are a buyer, Zillow tells you what happened yesterday. The 10-year Treasury tells you what is going to happen tomorrow.
Wow. So what does this all mean for us? We've covered a massive amount of ground today, pulling back from the macroeconomic math of debt limits all the way down to the micro decisions of which bank account you should be using.
To synthesize all of this, the U.S. housing market is not facing a repeat of 2008. It is facing a mathematical affordability collapse driven by high rates and high prices.
Right.
Your specific financial exposure depends entirely on your current housing status. If you are an owner with a low rate, your best move is to stay put. If you're a buyer, you need the interest rates to drop, not just the sticker prices.
Yeah, the shipping and handling fee.
Exactly. And if you are a renter, you need to prepare for broader economic ripples impacting your job sector. But For all three groups, the playbook remains identical. Lock in your liquid emergency fund, utilize high-yield savings accounts to take advantage of the current high rates, and watch the 10-year Treasury yield as your true indicator of when this frozen market will finally thaw.
It's all about being proactive rather than reactive. But there's one detail from the data we've discussed today that has just been echoing in my head. We talked about how 85% of current homeowners are locked into these sub 5% mortgages, absolutely refusing to move.
Yeah, the lock-in freeze.
Right. And I want to leave you, our listener, with a provocative thought to ponder on your own this week. What happens if this lock-in effect stretches on not just for a couple of years, but for an entire decade?
That's a profound question.
Think about the implications of that. If nobody can afford to upgrade when they have their second child, or downsize when they retire, or sell their house to move across the country for a better job opportunity, does the traditional concept of the starter home disappear entirely?
It very well might.
And if an entire generation of Americans is financially frozen in place, how will that permanently alter the way our local communities grow, how our neighborhoods evolve, and really how our society functions? It's a lot to chew on. Keep questioning the data, keep looking past the sensational headlines, and keep thinking about how these massive systemic shifts impact your own front door. Thank you for joining us on this deep dive. We'll see you next time.